Yeah, I like that. And then I feel like one of the more underutilized savings vehicles is that brokerage account. And just to kind of talk through the basics of what a brokerage account is, what are capital gains taxes, short term, long term, and how that can complement, the ones we're really familiar with, which is the Roth, which is the, taxed already, and then the traditional, tax
Yeah.
deferred. Yeah.
Yeah. I think just regular brokerage accounts don't get enough love in people's eyes because they think it's got to be the retirement account, the IRA, the 401k, the federal thrift savings plan, whatever it may be, or the Roth version of those things. And that's it. There's a lot of flexibility to regular brokerage accounts. So in technical IRS tax speak, the other accounts I just mentioned are all quote unquote qualified. Again, IRAs, Roth IRAs, 401ks, Roth 401ks. Qualified simply means they have special tax status. The money you put in, you can get a deferral on paying tax on that. Or in the case of a Roth, you can take it out tax free down the road if you meet certain conditions. Regular brokerage accounts are called non qualified because there's no special tax status to it. They get the normal tax treatment, if you will. So, what is that tax treatment? Um, the money you put in gets you no special tax benefit or deduction or deferral because it's money that's already been taxed. You buy whatever. It could be a stock, it could be a bond, it could be a mutual fund, it could be a bank CD. That's a non-qualified product as well. You're only taxed on gains or income that you get on that money. Now, when you get taxed, that's where things get a little trickier. For example, if you buy a stock for a price of 100 and you hold it for the rest of your life, you'll only have to pay tax on it when you eventually sell it, and assume you sell it for more than what you paid for it. So let's say you sell it for 150. So you have a $50 gain, you bought it for 100, sell it for 150. That $50 gain will be taxed in the year you sell it. It's not taxed along the way while the price, goes up during your lifetime. Or if you sell it at a loss, you sold it for 90, you bought it for 100, you can that $10 loss can actually help you. It can reduce your tax bill a little bit that year. So that's gains or losses. Interest and dividends, things that are thrown off during the course of the year, those are taxed in the year you get them. So, for example, you have a bank account, a savings account that pays you interest every month. That interest is taxable in the year you get it. You own a stock, you own a mutual fund in a brokerage account that throws off dividends every quarter. Those dividends are taxed in the year you receive them. One thing people don't know is if you have your dividends set up to automatically reinvest into buying more shares of that stock or that mutual fund, even though you don't see and get direct use of that cash from that dividend, like you immediately plowed it back into more shares, it's still taxable nonetheless in the year you got the dividend. So it's functionally as if you got it and you chose to turn around and buy more shares with it. So in that sense, you did actually get the dividend, even though you don't really see it. So that in a nutshell is how
Sure.
these non-qualified accounts are taxed. And just one other consideration while we're on it is from like legacy planning purpose, there's something called a step up in basis where when you die, everything you owned in this account goes to whatever heirs you designate as the beneficiaries of your estate. All of the gains you may have had, the unrealized gains. So again, that example, I bought a stock for 100. Let's say I never sell it in my lifetime. It's worth $150 when I die. There's $50 of not yet realized gains. That all magically goes away when I die, and my heirs inherit it at a price of 150. So just like that, everyone wins except the government because that gain just disappeared and my heirs pick up and run with it as if they bought it for 150, when they inherit it from me. So that's something else to keep in mind with these regular non-qualified brokerage accounts is they are also powerful, estate planning / kind of wealth transfer tools.
Sure. And it's not the majority, but I'm sure there's some people entering retirement that have ample cash flows and they still want to invest, but they can't invest in these IRAs and these, company 401ks, their retirement. And this is the vehicle that kind of keeps you in the game, so to speak, right?
Correct. And it doesn't need to be a brokerage account where you're buying traditional stocks, bonds, mutual funds. If you already fill up your qualified retirement account at work or your qualified IRA or Roth IRA, for example, which do have IRS imposed contribution limits every year, and you have extra money you want to save, there's lots of things you can do with it. Like, yes, you can put it into a regular brokerage account where there are no contribution limits. You can put it into bank accounts and buy, CDs or savings accounts where there are no contribution limits. There's insurance limits you want to be aware of, FDIC insurance limits. You can buy real estate, for example, buy a second property as a vacation house to use, or a rental property as an investment to rent out. You can do that with the money. This again, there's other considerations for things like life insurance. You could sort of view certain forms of life insurance as an investment-like product that you can put some of this additional money into. So there's lots of things to do with it. And definitely the regular good old-fashioned brokerage account is, shouldn't be overlooked. I think a lot of people don't give it enough love, and it has a lot of flexibility to it.
The opinions and statements presented on this show are for general information only and are not intended to provide specific advice or recommendations. Never make any investment or financial decisions based on information offered on this show without first consulting your financial, legal, or tax advisor. All economic and performance information mentioned on the show is historical in nature and is not indicative of any future results. All indices mentioned on this show are unmanaged and cannot be invested in directly. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Lastly, all opinions expressed by Jason Cutitta and any guests on the show are solely their own opinions and do not reflect the opinions of or are endorsed by ToBA Financial. For Jason Cutitta, investment advisory services are offered through ToBA Financial LLC, a registered investment advisor offering advisory services in the state of Hawaii and in other jurisdictions where exempt from registration.